We're going to go over Schedule C of your income tax return for IRS Form 1040 or 1041. So this is the tax form that records your profit or loss from business if you are a sole proprietor. However, it also includes certain other items of income, such as wages and expenses that you might have had as a statutory employee, income and deductions from certain qualified joint ventures, and then certain amounts that are shown on a Form 1099, such as Form 1099 MISC, 1099 NEC, and Form 1099K. So these are different tax forms that you might see as part of kind of the gig economy. Uber and ride sharing apps, but then also DoorDash. A lot of people are going into business for themselves, so to speak. And according to the Internal Revenue Service, unless all of that income is structured under a separate tax entity, then this needs to be reported on Schedule C when you file your income tax return. Now, if you are filing Schedule C, there are other forms you may have to file, and we'll put links to these forms in the show notes for you. So you might file Schedule A if you're deducting certain expenses such as income, interest, taxes, and casualty losses that are not related to your business. You might file Schedule E to report rental real estate and royalty income or losses that are not subject to self-employment tax. So for Schedule C filers, your income here then gets reported onto Schedule SE, and then you generally are taking taxes out of that income. So you might be, if you're a farmer, you might file Schedule F to report your profit or loss from farming activities. Also, if you're a farmer or a fisherman, you might file Schedule J to calculate your tax over an average of a 3-year period, which might lower your tax bill. There are also a variety of forms that you may need to file along with Schedule C, depending on the circumstances. So to report excess business losses, Form 461. If you're eligible for general business credits, IRS Form 3800. Depreciation and amortization is on Form 4562. 4684 reports casualty or theft losses. You would use this if you were listing your casualty or theft loss on your personal tax return. But if you have the opportunity to declare that loss on Schedule C instead, you may receive a bigger tax deduction simply because Schedule A forces you to itemize deductions, and then you have to compare that to the standard deduction you would be otherwise eligible for. Form 4797 reports sales, exchanges, and involuntary conversions of business property. If there are at-risk limitations based on the amount of money that you've invested in the business, you may file Form 6198 that applies at-risk rules if there are certain parts of your investment that are guaranteed against loss. If you have income from an installment agreement, you may file Form 6252. Passive activities, if you have passive activities and you're calculating how much of the loss that you can deduct from your tax return, you may need to file IRS Form 8582 that applies a limitation to losses from passive activities. Asset acquisitions, if you acquired or sold a business that has assets as part of the business, then you may need to file Form 8594. If you participated in a like-kind exchange, particularly with vehicles or other personal property items, you may file IRS Form 8824. You may file IRS Form 8990 if your business interest deduction has limits to it. You may file, if you have high enough income, you may need to file IRS Form 8960 to calculate your net investment income tax. And finally, you may need to file IRS Form 8995 or 8995A to claim a deduction for qualified business income or QBI. All of these different forms may interact with Schedule C, either adding items to Schedule C based on those calculations, or Schedule C calculations then feeds the appropriate form. So that's a list of the forms that may be involved for taxpayers that choose to file Schedule C. If you are a small business owner, you probably should absolutely have a tax professional help you, or just hire a tax professional, partially because they're going to be much more familiar with all of these different forms and how they interact with your Schedule C. And they're also going to be more knowledgeable about the types of deductions that you can take in the form of expenses. They might bring up ideas that you weren't aware of. They might tell you rules and regulations that you did not know about. In other words, there is a chance you might save a lot more money than you spend on an accountant or an enrolled agent. But on the flip side, at the very least, you're probably going to be much more compliant with the rules and regulations and the tax laws involved. So for most business owners, it's best for you to focus on your business and allow your tax professional to take care of the tax stuff, particularly reporting items on Schedule C. With that said, we're going to walk through this form. This is a 2-page tax form. There are 5 parts. We're going to kind of walk through them and through each of these parts through the eyes of our hero, John Doe, who has an investment advisory firm. He's a financial planner. In part 1, we'll go over his income. In part 2, we'll go over expenses. In part 3, we'll touch on cost of goods sold. However, since John Doe is a financial planner, there is really no goods for him to sell. So we're going to kind of do this separately, just walk through the mechanics of how you would calculate the cost of goods sold, because that simply becomes a line item up here on part 1. So we'll go through that separately. In part 4, we'll complete this part as if we used a vehicle for driving purposes so that you could claim car or truck expenses on line 9. It turns out in this situation, John Doe, our hero, filed IRS Form 4562, so he does not need to complete part 4. And then part 5 will go over other expenses that you could claim as a business expense that was not included in part 2 or in line 30 up here under expenses for the business use of your home. So there are certain rules that may apply if you and your spouse own a business. You can elect to be treated as what's called a qualified joint venture. So basically, it gives you the ability to treat your business as if it were a partnership, but you're not filing IRS Form 1065 the way a normal partnership would. There's a little bit more complexity in filing partnership returns. So filing as a qualified joint venture allows a married couple to participate as if they were going through a partnership without having to file the extra paperwork. They can simply claim their profit or loss as a joint venture through Schedule C. So there are additional details in the form instructions about how to go about setting up a joint venture, when you can obtain it, for what reasons. For example, you have to have an actual business. You can't just own a couple of rental properties and call it a joint venture. You have to actually have a business that operates between the two spouses. You can revoke the election once you've made it as a joint venture, but you only need to do that. You can only do that with the IRS's permission. So the election remains in effect as long as you and your spouse continue to meet the requirements to make that election. So you would each file a separate Schedule C or Schedule F, apply your share of the income, deduction, losses. You may need to file a separate Schedule SE so that you can each pay self-employment tax. So let's go to the line-by-line instructions. At the top of the form, we've entered our hero's name, John Doe, and his social security number. In line A, we've entered his principal, business, or profession. So at the end of the form instructions for Schedule C, you'll see a very long list. It's about a 2-page list in very fine print with a variety of different businesses and professions that are classified by the federal government. So I selected investment advisory services, and the applicable code from the form instructions happens to be this number right here that I've entered in the box. So the business name, Doe Financial Services. You don't have to have a name here. Sometimes it's just John Smith doing whatever John Smith does to earn a paycheck. So you don't have to put a business name if you don't have one. If you have an employer ID number that was issued when you filed Form SS4, then you would enter it. Don't enter your social security number, and don't put in another taxpayer's EIN. So if you don't have one, just leave it blank. You are required to have an EIN only if you have a qualified retirement plan, or if you're required to file employment, excise, alcohol, tobacco, or firearm returns, or if you are paying out gambling winnings. So probably not a long list of taxpayers that fit that category. In line E, you're going to enter your business address. Include your suite or room number if you're in an office building. Do include your street address instead of a P.O. box number. So if you filed this from home and that's where you operate your business from, and that's already on your tax return, you don't need to repeat that. So if your business address is the same as your home address, you can leave that blank. In lines F through J, you're going to select a series of boxes. In line F, you're going to determine whether you're using the cash or the accrual method for accounting. If you don't know the difference between those two, definitely hire an accountant. And definitely turn over your QuickBooks or whatever your bookkeeping software is to that person. But if you are somewhat familiar with the differences between cash, accrual accounting, then select the appropriate box. In line G, it asks whether or not you materially participated in the operations of this business. So either yes or no. If your business activity was not a rental activity and you met any of the material participation tests, or you happen to be able to meet the exception as an oil or gas well owner, then you would select yes. So without respect to actual participation, if you own a gas or an oil well, then you can state that you materially participated in the operation of that business. Otherwise, you would have to meet one of 7 material participation tests. So here they are. Test 1. You participated in the activity for more than 500 hours during the tax year. Test 2. Your participation in the activity for the tax year was substantially all of the participation in the activity of all individuals for the tax year. This includes individuals who do not own any interest in the activity. Test 3. You materially participated in the activity for more than 100 hours during the tax year, and you participated at least as much as any other person. Test 4. The activity is a significant participation activity for the tax year, and you participated in all significant participation activities for more than 500 hours. Test 5. You materially participated in the activity for any 5 of the previous 10 tax years. Test 6. The activity is a personal service activity for which you materially participated for any 3 prior tax years. So a personal service activity includes, it's an activity that includes personal services in the areas of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting, or any trade or business in which capital is not a material income producing factor. So in this case, John Doe would be a material participant based on test 6 and also test 1 and test 2 and several of the other tests. The final test is test 7, which indicates that the taxpayer participated on a regular, continuous, and substantial basis for more than 100 hours during the tax year. So if you meet any of those 7 tests, you get to check yes for material participation. In line H, check the box if you started or acquired the business during the tax year. In line 9, if you made any payments that would require you to file a Form 1099. This could be for an independent contractor. This could be for a wide variety of different different areas. So generally speaking, the difference between hiring consultant help to a business versus having to file a Form 1099, it really depends on whether you're hiring an individual or if you're hiring a business where an individual from that business helps you to perform whatever work that you need to do. So for example, if you hired Smith Law Consulting to help do legal paperwork and it cost you $2,000, you wouldn't need to file a Form 1099. But if you hired Mark Smith, who is an individual, and he happened to give you legal advice and you paid him $2,000, then you may have to issue him a Form 1099. And then in line J, if you did make any payments, are you going to file the Form 1099? I'm going to just give you a freebie here and tell you that if you check yes to line I and you check no to line J, you could probably expect an audit. So that's probably more of an intelligence test than really any indication that you need to check that box. So we're going to go over part 1, which is the income. In line 1, you'll enter any receipt like gross receipts or sales. So according to the form instructions, this includes anything that you received as a business income item on Form 1099. You could have 1099 NEC. You could have a 1099 MISC. You could have a 1099 K, which is actually for cash transfers using a cash management app like Venmo, something like that. So that is a relatively new tax form that is going to hit a lot of people by surprise, specifically in this gig economy where more people than not are used to being 1099 employees or contractors in at least one job if they have multiple jobs. So if you received any 1099s, this is where it's going to go. Now, there are a couple of notes in the form instructions we should go over. For statutory employees, you would check the box right here. If you received income on a Form W-2 and then the statutory employee box in box 13 was checked, you would check this box and then you would include that amount. That is an amount that Social Security and Medicare tax should have been withheld, so you should be able to separate any self-employment tax liability from that income. Statutory employees include life insurance agents, certain agent or commission drivers, traveling salespersons, and certain home workers. If you had statutory employee income and self-employment income, then you would need to file a separate Schedule C for each of those items. You can't have statutory employee income on the same Schedule C as self-employment income. Also, installment sales, generally speaking, you can't report income from the sale of either personal property or real property. You can't use the installment method, but you can use the installment method to report certain income from sales of timeshares or residential lots. If you need to go that far down the rabbit hole, then definitely check out the form instructions to make sure you're properly recording that. In line 2, you'll report any sales returns and allowances as a positive number. So a sales return would be a complete cash or a credit refund to a customer that returned an unwanted product or a defective product. A sales allowance is a reduction in the sales price instead of a cash or a credit refund. So either a reduction in price or just a return, you would enter that here. So if John Doe, say, refunded someone $1,000 of their financial planning fee, he would enter that money right there. And then in line 3, you're going to subtract line 2 from line 1. In this case, we've got none. In line 4, we'll calculate cost of goods separately in a hypothetical situation, but since John Doe does not have a goods-based business, he does not have a retail business, we don't really have a cost of goods sold. So, but if you had a number in here, let's just say $10,000, then you would subtract that from your line 3 to arrive at your gross profit. So instead of $100,000, this would be $90,000 if we had any goods that we had to calculate the cost sold. So in line 6, we're going to report other income. This could include finance reserve income, scrap sales, bad debts that you eventually recovered, as opposed to bad debts that you write off under other expenses down here. So if you write off a bad debt in part 5 and you actually use it to reduce your income tax in the current year, and then the following year you have a bad debt that you wrote off that is repaid to you, then you need to include that amount in other income right here. State gasoline or fuel tax refunds that you received in the tax year, credits for biofuel that you claimed on either IRS Form 6478 or 8864. If you paid tax on fuels and you claim, like if you claim the credit and you actually receive the credit, you can put that in there. Prizes and awards related to your trade or business, any amount of payroll tax that was taken by an employer for qualified paid and sick leave, if that tax credit that credit was only available like during certain periods of coronavirus, so that's generally not applicable for 2022 or later. But if you're filing for a previous year, or if you're amending a previous year return, that might be applicable. So once you have your other income items, you simply add lines 5 and 6. That is your gross income. So in part 2, we're going to now record certain expenses. For simplicity, I've entered $1,000 for most of these line items, except for a few that we'll lightly brush over. Financial planners don't really have to worry about depletion expenses. So there are a couple of items here where that might not be applicable. So in line 8, you would enter any advertising expenses. This could be internet advertising. This could be billboards. This could be television ads, radio spots. Whatever the advertising costs are, you would enter that information here. When it comes to car and truck expenses, you can either record actual expenses, or you can take a standard mileage rate and apply it to your business miles. So you can only do that if you own the vehicle and use the standard mileage rate for the first year, or if you leased it and you're using the standard mileage rate for the entire year period. So if you started off deducting actual expenses, you have to keep doing that. And so if you use the standard mileage rate for tax year 2022, it's a little bit more complicated than most tax years. So first of all, you have to determine the difference between business miles versus either commuting or personal miles. And then for the first half of 2022, you will multiply your business mileage by the standard mileage rate of 58.5 cents per mile. Then from July 1st through the end of December of 2022, that mileage rate becomes 62.5 cents per mile. And then you can add parking fees, tolls, and you can enter that amount on line 9. If you use a standard mileage rate, do not include any depreciation, rent, or lease payments, or any actual costs. So if you're using the actual cost method, you would include gasoline, oil, repairs, insurance, license plates. For depreciation, you would actually show that on line 13. For rental or lease payments, you would show that on line 20A. But if you're using the standard mileage rate, then the only depreciation, you cannot include car depreciation on line 13. You cannot include your vehicle lease or rental costs in line 20A. In line 10, if you had any commissions or fees for the tax year, you would enter them here as long as you did not have to capitalize them or deduct them elsewhere on your return. So a general rule for Schedule C is certain expenses may be expensed in the year. Certain expenses may have to be capitalized. So you can't take a completely capitalized expense and expense it in 1 year. You have to draw it out and take a certain amount of that deduction each year that you have that property. And then when it comes to expenses or fees that you can claim elsewhere on your tax return, that's where your tax professional would come in handy, right? So if you're talking about casualty or theft deduction of a piece of property that could have been business property versus personal property, that's when you would talk to your accountant to make sure you kind of understand what the tax rules are and how they would apply to your situation, so you can put that deduction in the correct place. So in line 11, you would enter the cost of any contract labor that you need to file Form 1099 NEC to report any labor payments of $600 or more during the tax year. As a general rule, you have to file a 1099 for payments of $600 or more to the same person. So if you Venmo someone $600, I believe Venmo is going to start making people actually issue 1099Ks out of that. So, and again, just because you reported $600 of income doesn't mean you're paying taxes on it. You very well could find legitimate expenses that still exceed that income that you report. So, part two really is all about finding and reporting legitimate expenses to reduce your tax liability. In line 12, you would enter depletion deductions. So if you don't know what depletion is, it probably doesn't apply to you. If you have timber depletion, you would attach Form T for timber. So if that doesn't apply to your situation, then that's to be expected. Depreciation and Section 179 expense deduction. So depreciation is where you take the cost of, let's just say, a vehicle, and instead of expensing the entire vehicle in 1 year, you have to actually divide out the depreciation over the expected life of that vehicle, and you would take a certain amount each year until that vehicle is depreciated at the end of its expected life. So it doesn't mean that you have to get rid of it. It just means that once it's fully depreciated, you can no longer take a tax deduction based on that depreciating value. You can still take a tax deduction based on your operating costs, your actual expenses for operating the vehicle, but you can no longer take a depreciation deduction. Section 179 basically states that there's a part of the tax code in certain circumstances that allows taxpayers to take a significant depreciation expense in the first year that you put it into service. And that dollar amount fluctuates or changes every year, but it's a significant amount. So if either of those rules would apply, you're probably going to file IRS Form 4562 to calculate your deduction for either depreciation or Section 179 expense. In line 14, these are contributions to employee benefit programs that are not part of a pension plan or a profit sharing plan. So this could be like group term life insurance policies, a dependent care assistance program, accident and health plans. Now, if you're self-employed and you contributed to a dependent care assistance program, then you should complete IRS Form 2441 because that would be the tax credit for for child and dependent care. So if you're able to take a tax credit, you're not able then to turn around and claim a tax deduction on it. And you are better off taking a tax credit for that expense. You may be able to include some expenses in one form and some expenses in a different form, but you really need to be familiar with the instructions for each of those forms to make sure that that you're allowed to do so. In line 15, you're going to enter any insurance costs besides health insurance. So this would be like employee accident, employee accident and health insurance would be under line 15. So any other type of insurance policies, you would put those premiums in line 15. For lines 16A and B, you're going to enter the amount of mortgage that or the amount of interest that you paid in operating your business. This may be subject to business interest limitations. You would file IRS Form 8990 to calculate any limitations that might apply. So if this was a mortgage, like you took out a home equity line to start your business, and to the extent that it's interest that actually, purchased or paid for expenses in your business, you would enter that information on line 16A. If it was just another loan that wasn't a home mortgage, then you would enter that on 16B. If you don't receive a 1098, enter the interest on 16B. In line 17, you'll include any legal or professional fees that are considered to be ordinary or necessary directly related to your business. This could include tax advice. This could include tax preparation. You could also include if you uh, had a tax deficiency assessed by the Internal Revenue Service or your state board of revenue, you could include any costs that you had to hire a CPA or an attorney or an enrolled agent to help you navigate through that. In line 18, you would include office supplies and postage, not necessarily home office deduction. That would go elsewhere, and we'll get to that momentarily. But office supplies and postage pretty much cover this. In line 19, you would enter your deduction for employee contributions to a pension, to a profit sharing, or an annuity plan. If this is just you as a self-employed individual, you would enter your contributions on Schedule 1 and not Schedule C. But if you do have employees, then you would file either IRS Form 5500 EZ. This actually is the form you would file if you don't have employees. This is for a one participant plan that meets certain requirements. And a one participant plan could cover you, or it could cover you and your spouse as part of a qualified joint venture. Technically, you'd be a one participant plan with a spouse. If you have fewer than 100 employees, you could file IRS Form 5500 SF. And if you have a retirement plan that doesn't meet any of those requirements, you would file IRS Form 5500. So in line 20, A and B, we're going to include the cost of rental or leasing either vehicles, machinery, and equipment. So if John Doe leased a car and spent $1,000 on it, then you would enter that on 20A. If you had other lease or rental costs like office spaces, if you rented, I don't know, other personal property that wasn't included in 20A, then you would put that in line 20B. In line 21, you would deduct the cost of incidental repairs and maintenance that don't add to property value. So, this is simply repairs and maintenance. This is not property improvements. Don't deduct the value of your own labor and do not deduct any amounts that were used to restore or replace property. Those costs must be capitalized. In line 22, you'll include any supplies that you did not include in part 3 under cost of goods sold. So you can only deduct the cost of supplies to the extent that you consume them and use them during the tax year. You may be able to deduct other costs of things that you consumed. General rule is as long as the expected life was less than a year. If it's more than a year, then you may have to depreciate that instead of expensing it. So, for example, the form instructions state that you can deduct the cost of books or professional instruments if you normally use them within a year. But if their usefulness extends substantially beyond a year, then you may have to recover their costs through depreciation. Oops, my apologies. In line 23, you're going to enter taxes and licensing fees. So here's a quick partial list of what that might look like. State and local sales tax that was imposed on you as a seller of goods and services. If you collected this tax from the buyer, then you also, and you're taking that deduction, you're going to have to report that as income on line 1. Real estate and personal property taxes on business assets. You can report any license or regulatory fees that you have to pay to your state or local government. For example, John Doe has to pay every year to file his Form ADV as an investment advisor, so that fee would go in here. There are some licenses that may have to be amortized, such as liquor licenses. I imagine the taxi cab medallions would probably fall into that category. IRS publication 535, Chapter 8 will contain more detail. Social Security and Medicare taxes that you paid to match required withholding, but you would reduce your amount if you had to file IRS Form 8846, you would reduce that amount by the line 4 in that form. If you paid unemployment tax at the federal level, highway use tax at the federal level, or contributions to a state unemployment insurance fund or a disability fund, if they're considered taxes under state law. You cannot deduct federal income tax, estate and gift tax, taxes for assessments like property improvements. You cannot take a tax deduction for your home or personal use property, state and local sales taxes on property that you used in your business. You would simply report that as part of the cost of the item. In line 24, we're going to cover travel and meals. So in line 24A, you can enter your expenses for lodging and transportation connected with overnight travel as long as you're away from your home. Your tax home is your main place of business, regardless of where your family lives. You can't deduct any expenses that you paid in connection to employment away from home for more than a year. So if if you went on a temporary assignment and you had to pay out of pocket for your travel and meals for a 3-month period, then you could put the travel expenses here. You could deduct 50% of the meals unless you were in either tax year 2021 or 2022. In that case, then you could deduct 100% of the meals that you consumed while you were on travel. But if that temporary assignment was expected to be a year plus, then you cannot use this to claim that deduction. So business meals have to be considered an ordinary and a necessary expense. They cannot be lavish or extravagant. You or an employee of yours has to be present at the meal. The meal has to be provided to a current or potential business customer, client, consultant, or a similar contact. And you have to purchase these food and beverages separate from any food or beverages that you might provide as entertainment so if you went to a convention and you're responsible for throwing the convention, you might have legitimate meals that you would pay for that you could deduct, and then there would be entertainment expenses that you could not deduct here. You may find another place to deduct them depending on the nature of your business, but you would not be able to deduct those entertainment expenses here. Line 25, you're going to include the cost of utilities. So if you have a phone line, you can't, and you use your home phone for your business, you can't deduct the first phone line cost. But anything that's above and beyond the cost of the first phone line, you can include that. Wages, you would include any wages in line 26 unless you would have to reduce the amount of the wages that you report based on these following tax credits. So the work opportunity credit, the employee retention credit for employers affected by qualified disasters, the empowerment zone employment credit, the Indian employment credit, the credit for employer differential wage payments, and the employer credit for paid family and medical leave. So you're much better taking the credit anyway in that circumstance instead of the tax deduction, but you can't use the same wages that you paid to earn a credit and then turn around and take a tax deduction. In line 27A, that's a number that we're going to bring up from line 48, which we'll get to. And then line 27B, don't put anything in it. So in line 28, we're going to total all of the expenses that we just talked about, and we arrive at $20,000. So when we subtract that from our line 1 number, we're now at a tentative profit of $81,000. In line 30, you can include expenses for the business use of your home, as long as you do not report those expenses elsewhere. You would either attach IRS Form 8829, which calculates expenses for your home office use, or you could use the simplified method. The simplified method, basically, there's a worksheet in the form instructions, but generally speaking, in this situation with our hero John Doe, when we work through the worksheet, you're allowed to take up to $5 per square foot for up to 300 square feet of your house that you use as a home office. So if you have a 1,000-foot home office, congratulations, you can only use 300 feet of that home office for this tax deduction. And you would simply multiply the 300 by the $5 maximum allowable amount. You would enter that in here. There are certain other exceptions or factors that may impact your calculation in the worksheet. So do pay attention to the worksheet and the form instructions to make sure that none of those limitations apply. So in this case, they don't. We're taking a $1,500 deduction here, and that reduces our net profit to $79,500. We would report that as a profit on Schedule 1, line 3, and then also on Schedule SE, line 2, so that from there we could calculate self-employment tax. For estates and trusts, you would enter this information on Form 1041, line 3. If you're reporting a loss, you have to go to line 32. This kind of walks you through at-risk rules to determine how much of your loss you can take on your tax return. If all of your investment is at risk, meaning that there's none of your investment that's guaranteed against loss, there's not any kind of a provision in any contracts that you hold that make you whole if your business goes down the tubes, then you're considered to be at risk for the entire investment. If your investment is completely or partially protected, then you would have to complete IRS Form 6198 to apply the at-risk rules and determine how much your deduction may be. So in this case, John Doe, it's all his money. There's no safety net. All of his investment is at risk. So if he had a loss, then he would be able to deduct it in full. In part 3, we're going to walk through this for illustration purposes. This is not John Doe's requirement, since he doesn't have cost of goods sold. So you would use either the lower of cost or market or cost to value your closing inventory. And there are specific rules on when you can change that. You can use another method that was approved by the IRS, but let's just say that we are valuing our inventory at cost. And then you would indicate whether or not there was a change in this accounting method between opening and closing inventory. In this case, no. And now we're just going to take a rough calculation of the inventory at the beginning of the year, basically adding in purchases, the cost of labor, materials and supplies, and then we're going to take a calculation of the inventory at the end of the year, and we'll net the difference. So let's just say we had $100,000 of inventory at the beginning of the year, and then we had $20,000 of purchases. Now, if you took items out for personal use, you can't consider that a purchase. That's just, that's you. So let's just say $20,000 of labor, $10,000 of materials and supplies, and then $10,000 of other costs. There's not really a lot of instruction in the form instructions on what other costs could look like. So we're going to add these items up. So this is $160,000. And then we're going to do our inventory at the end of the year would be $100,000. I mean, it doesn't have to be. Let's just call it, let's say, $50,000. So then we subtract out, all of this information, and we subtract out the ending inventory, and we get $110,000. That is our cost of goods sold. We would enter that up here on line 4. So instead of 0, which is what we currently have, that $110,000 would go here. In part 4, John Doe did not have to complete this form, but we will go through this briefly. So let's imagine that we place the vehicle in service at the beginning of 2022. And of the total number of miles that you drove, enter the number of miles that you use your vehicle for. So business, commuting, and then other, meaning probably personal or at least not tax deductible purposes. So now commuting basically means that you're going from your home to your primary place of business, and that is not tax deductible mileage. However, there are certain situations where it might be difficult to tell what is commuting and what is not. So I'll outline what is not considered commuting mileage according to the form instructions. And then if there's mileage that fits one of those categories, you can categorize that as business and not commuting. So if you have at least one regular work location away from your home and the travel is to a temporary work location in the same trade or business. So typically this is where your employment is expected to last a year or less. So it doesn't matter what the difference is. It doesn't even matter if your temporary work location is closer to your home. You're not going to your natural place of business. You can deduct that mileage. If the travel is to a temporary location outside the area where you normally, where you live and normally work, or if your home is your principal place of business and the travel is to another work location in the same trade or business. So in this case, if John Doe were to operate his financial planning firm out of his house, and then he drove to an office to see clients, like a WeWork space or something like that, or if he drove to a client's house, then he could use all the miles that he drove to people's houses as part of this deduction. So let's just say for business purposes, he drove 20,000 miles, he commuted 5,000, and then he drove 5,000 of personal. So basically 30,000 miles total, 2/3 of that was considered business. If your vehicle was available for use during off-duty hours, indicate yes or no. Do you or your spouse have another vehicle? These are all kind of things that the IRS kind of checks for when evaluating whether or not you should be able to deduct business mileage from this. So if you don't have written evidence, then you should probably not be claiming this deduction. However, you should know that when you're using mileage, you should keep a mileage log. There are a handful of apps that can do that. You can capture it on the good old pen and paper or Excel spreadsheet method as well. So if you do have evidence, then you need to make sure that you're reporting its written evidence because this would come up during an audit. IRS publication 463 contains more information about record keeping requirements. So in part 5, basically we're entering any other expenses that would not be included. This could include amortization, at-risk deduction. So in this case, this was a previously disallowed at-risk loss deduction from the previous tax year because of the at-risk rule. So it was carried forward. he's now able to deduct that here. So that realistically wouldn't apply since we did check the box that said all of his investment was at risk. But that was kind of the illustrative example. Other expenses, you could write off bad debts in this section. You can write off up to $5,000 of business startup costs. There is a dollar for dollar reduction in that limitation if your startup costs are greater than $50,000. So, not that you can't eventually write off your startup costs, but in the year that you start your business, you can deduct up to $5,000 in that year, and then the rest of it has to be amortized over 180 months or 15 years. Deduction for removing barriers to individuals with disabilities and to the elderly. So you can deduct up to $15,000 of costs as long as you didn't include those costs on IRS Form 8826, which is for a tax credit specifically for disabled access. A de minimis safe harbor for tangible property, energy efficient commercial buildings deduction if you put retrofittings into a commercial building to make it energy efficient. You would file IRS Form 75 or 7205, and then you would put that expense here. Forestation and reforestation costs, film and television and live theatrical production expenses. So now that we're starting to scrape the bottom of the barrel of these expenses, we'll total them up in line 18. We've got $1,000 here, and we're going to take that up to line 27A where we have $1,000. So that was a comprehensive view of what you would see in completing IRS form or Schedule C. So again, you can do this if you feel confident that your records are in order and that you have familiarization with the rest of the tax forms that you may be required. Odds are, if there's a tax form that you need additional instruction on, we've probably written an article about that, or we've produced a YouTube video. So if you want to know more about filing Schedule C, we've written a comprehensive article that you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Schedule C, and you'll see our full-length article. If you have a question about a specific tax form, odds are very high that we've written an article about that tax form. Simply type in the name of the tax form, such as IRS Form 8829 for home office expense deduction, IRS Form 4562, for example, if you're claiming car or truck expenses. So look up that article if you need to on the website. You could also probably search for it in our YouTube collections. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any other questions or comments, please post them in the comments section. Thank you very much and have a great day.